Hi, I'm Lucas Niewenhuis, a news editor and trade war correspondent at SupChina based in New York City, and today we'll be talking about China's so-called nuclear option of weaponizing US Treasury holdings. Right now, China is neck and neck with Japan as the top foreign creditor of the US, holding $1.1 trillion in US Treasury bonds. That accounts for 4 to 5% of America's national debt, which is a staggering $22.5 trillion. America's addiction to debt and China's willingness to buy it is nothing new. But the continual escalations of the US-China trade war have revived worries that China will try to weaponize its US Treasury holdings. China could, in theory, sell off a massive amount of US debt in an attempt to destabilize the American economy. The media has become fond of calling this China's nuclear option. But the nuclear option is overhyped. It is technically true that a sell-off of American debt could destabilize the US. That's because flooding the foreign exchange markets with potentially hundreds of billions of dollars in American debt would decrease the price of US Treasury bonds and increase their interest rates. The interest rates on US Treasury bonds are the benchmark for borrowing throughout the economy, so essentially all investment in the US would become more expensive overnight. But China would almost certainly not go this route. First of all, because it would not be very effective. No central bank in the world outside of China other than the US Fed has enough resources to buy so many treasury bonds at once. So the Fed would just buy back most or all of the treasuries that China floods the market with. But perhaps more importantly, the nuclear option would also hurt China and would, in fact, exacerbate the worst direct effects of the trade war. Why is that? The amount of foreign reserves that China holds and the strength of the Chinese currency, called the renminbi or the yuan, are inversely related. When China buys more foreign reserves, the yuan weakens. When China sells foreign reserves, the yuan strengthens. The last thing that China would want in an all-out trade war is for the yuan to strengthen. A stronger yuan means that the price of Chinese goods for anyone outside China wanting to buy them goes up. That's bad for Chinese exporting firms that want to sell to foreign consumers. A bit of history on the Chinese currency value relative to the US dollar. For about a decade, from the mid-90s to the mid-2000s, Beijing kept the yuan pegged at about 8.3 yuan to the dollar, a fairly low rate that undervalued Chinese products for global consumers. That was advantageous for Chinese exporting firms and is the origin of Trump's accusation of Chinese currency manipulation. But Trump is behind the times on Chinese economics. For over 5 years now, China has not undervalued its currency. Instead, China has propped up its currency against market forces to keep it stable. This was obvious during the first year of the trade war, as the yuan bounced twice, close to 7 to the dollar, but never broke that limit because the Chinese central bank didn't allow it. Beijing only allowed the yuan to depreciate beyond that level once the trade war entered its second year, and Trump announced yet another tariff escalation, putting a trade deal far out of reach in the near term. For years, China has bought American debt primarily as a tool to keep its exchange rate stable. In summary, it is unlikely to do a massive sell-off of American debt, largely because it would destabilize the exchange rate. Beijing wouldn't just hurt the US with that move, but would also be shooting itself in the foot.